Welcome to the deep dive. If you're looking to move beyond surface level market tips and really understand what drives stock success, well, you're in the right place. Today, we're distilling some powerful insights from a pretty renowned guide on how to make money in stocks. We're aiming to cut through the noise, get to what truly matters. Have you ever felt just lost trying to make sense of the stock market? You get bombarded by jargon and, well, frankly, conflicting advice. Our mission today is to equip you with a framework, a powerful one, to actually understand what the market is telling you. The goal is to help you become a more informed, more disciplined investor. We'll break down a specific strategy, highlight some common traps to avoid, all so you can make decisions with, well, more confidence.
Yeah, and what's truly fascinating here, I think, is how timeless these principles are. The source material, it draws on over 100 years of market winners. It reveals these patterns in human nature, crowd psychology, and the fundamental law of supply and demand. And these things remain remarkably constant. It's really about learning what actually works, not just what's popular or, trending right now.
Okay, sounds good. Let's unpack this then and get started on our deep dive into making smarter investment decisions. Surety, the foundation, a contrarian mindset, and the power of charts. So right off the bat, our sources challenge conventional wisdom. They basically suggest you shouldn't rely on market newsletters, advisory services, or even most analyst recommendations. That sounds pretty contrarian, right?
It absolutely is. And it raises a really important question. If not those sources, then what do you rely on? The material emphasizes that, analysts. They're often just expressing personal opinions, and those opinions can be spectacularly wrong. I mean, think back to 2000. You had Wall Street analysts still pushing buy recommendations on tech stocks, even as they were plummeting like 90%. The market, it speaks for itself. Turning into that signal is just far more reliable than listening to someone else's ego or, frankly, opinion.
Okay, so if we're not trusting the analysts, what are we trusting? What's the alternative?
That brings us to charts. No, they're often dismissed, right? Amateurs think they're too complicated. But professionals, they consider them absolutely essential. Their investment roadmap.
Yeah.
I mean, you wouldn't drive cross-country without a map, would you? Charts give you that same kind of critical navigation for investing.
So charts aren't just like historical data points then. They're actively telling us something about supply and demand right now.
Exactly. That's the key insight. If you connect this to the bigger picture, charts are simply supply and demand in action, visually. These patterns you see, chart patterns or bases, that's where a stock takes a breather. It digests its gains. So after a big run-up, the price corrects, it consolidates, builds a strong foundation. It's kind of like a spring coiling before its next powerful surge. Learning to diagnose whether those price and volume movements are normal or abnormal, signaling strength or weakness, that's crucial. Fortunes are made by people who properly interpret these patterns. It's not enough to just buy stock because it has good fundamentals. You always have to check the chart to see if it's in a proper position to buy. 2, the CAN-SLIM strategy, a framework for identifying winners.
Okay, that foundation makes sense. Charts is the map. So, with that laid out, our source introduces this CAN-SLIM strategy. It's a powerful acronym, apparently, for spotting leading stocks. Let's break it down letter by letter, starting with C.
Current quarterly earnings and sales per share.
Right. Current quarterly earnings and sales. This seems fundamental. The source states current quarterly earnings per share, the EPS, should be up a major percentage. We're talking at least 25% to 50% over the same quarter last year.
Yeah, fundamental is the right word. And a key nuance here, beware of those misleading headlines about record-breaking sales if they don't translate to strong earnings per share. For example, a company might shout about record sales up 20%. Sounds good, right?
It sounds great on the surface.
But if the earnings per share are dull, maybe flat or barely up, that's not what you're looking for. That EPS percentage change, that is the single most important element in stock selection, according to this source. It directly shows profitability and growth. And you also want to look closer, compare the EPS percentage change quarter by quarter. Is that growth accelerating? Or is it slowing down? Acceleration is a really powerful signal.
Annual earnings increases.
Okay, so one good quarter isn't enough, is it? You need to confirm the company has a strong, consistent annual earnings growth record. The source says over the past 3 years, apparently this weeds out about 80% of stocks right there.
That's right. Consistency matters. And beyond just the raw earnings growth, another key indicator is return on equity, or ROE. This tells you how efficiently management is using shareholders' money to generate profit. You find that great growth stocks, historically, they typically sport ROEs of at least 17%, often much higher, 25 to 50% even. And another thing to look for, cash flow per share. Ideally, it should exceed the EPS by at least 20%. It's a sign of really robust financial health. They're generating actual cash, not just, accounting profits.
Yeah.
And yeah, while looking at past giants like Xerox back then, or maybe Google more recently, gives you a model. The real focus should be on current and accelerating growth. You often find that newer, more entrepreneurial companies, not necessarily the older, larger ones where growth has maybe plateaued.
Newer companies, new products, new management, new highs.
And newer things. This points straight towards innovation, doesn't it? The source really highlights that the biggest winners often introduce something dramatic, a new product, a new service that actually revolutionizes how we live, not just like minor tweaks. They mention railroads, autos, and now things like semiconductors and the internet.
Exactly. And this ties into what the source calls the great paradox of the stock market. It's this idea that investing against your gut feeling is often the smartest move. What seems too high in price, too risky to most people, that often goes even higher. And conversely, what seems low and cheap usually goes lower.
Interesting paradox.
It is. Because when a stock breaks out to new highs from a strong base, it's signaling that professional money sees new value there. It's not just hitting a ceiling. Whereas a stock that looks cheap, well, it's often cheap for a good reason, and demand just isn't there, so it could fall further. Studies consistently show stocks hitting the new high list tend to keep going higher. The key is you want to buy them just as they're breaking out of a sound price base, that consolidation area we talked about, not when they're already, say, 5 or 10% above that point. Buying too late increases your risk of getting shaken out during a normal pullback.
Supply and demand.
Okay, supply and demand. We've covered the company fundamentals with C, A, and N. How do you actually measure this supply and demand dynamic in the market?
Right. You measure it by walking the volume, trading volume. This is where you see the footprint of professional money. When a stock breaks through that upside buy point, sometimes called a pivot point, the volume on that day should increase dramatically. We're talking at least 40 to 50% above its normal average daily volume. Sometimes it's huge. 200%, 500%, even 1,000% greater.
Yeah, that's a massive spike.
It is, and that signals significant buying by institutions, the professionals. Now, while maybe 95% of the general public is scared to buy at such high prices, your goal isn't to buy at the absolute cheapest price. It's to buy at the right price when that professional demand is clearly showing up and validating the move higher.
Leader or laggard.
L is for leader or laggard. Pretty straightforward. You want the best company in the best industry group. No sympathy stocks allowed, right? The ones that just kind of follow the leader.
Absolutely not. Avoid the laggards, the sympathy plays. This is all about identifying true leadership. Usually that means entrepreneurial management people willing to innovate, take calculated risks. You often see this in those newer, more nimble companies we mentioned under N. You want to avoid the older, larger corporations that might have sort of caretaker management. They produce mediocre results. They're less willing to shake things up. The source uses an example from 1970, Levitt's Furniture versus Wixcore. It clearly showed the difference between a true leader and a stock just tagging along, and it's really crucial to track the industry groups themselves. Weakness in one or two key stocks in a group can spread very quickly to the whole sector.
Institutional sponsorship.
Okay, it's an institutional sponsorship. We've touched on professional buying under S, so this means we need institutions involved. How much does this sponsorship really matter?
Oh, it's a huge factor. Huge. That big demand from institutional investors, mutual funds, pension funds, hedge funds, that's what drives most of the major price moves in leading stocks. But it's not just about the number of institutions owning a stock. It's also about their quality. Are they top-performing funds? And importantly, has that number increased recently? That shows growing interest. Plus, good institutional sponsorship provides market liquidity. That's crucial for you, the individual investor, when you eventually want to sell your shares easily.
But isn't there a risk here of just, following the herd? What happens if a stock becomes over-owned by institutions? Can that be a bad sign?
That's a very perceptive question. Yes, a stock can absolutely become over-owned. The source points to Xerox back in 1974. It was widely held by institutions. Analysts were still calling it a buy, and then it plummeted. So you need to try and separate intelligent, well-informed institutional buying from, poor or faulty buying, maybe late-stage buying. Think about 2000 again. Many analysts completely missed the boat, calling high-tech stocks buys even as they crashed 90% or more. Why? Partially because too many institutions were already in. The stock was effectively owned out. There was no one left to buy and push it higher, only sellers.
Market direction.
Which brings us to M, market direction. And the source suggests this might be the most important lesson of all, learning to determine the direction of the overall market. Because I guess If the tide is going out, doesn't matter how good your individual boat, your stock is, does it? You absolutely don't want your whole portfolio dragged down 30, 40, 50% or more in a nasty bear market.
Exactly right. You determine market direction by analyzing the daily price and volume action of the major market averages, the Dow, the Nasdaq, the S&P 500. The source details specific signs to watch for. One key warning sign is distribution days.
Distribution days.
Yeah, that's when a major market average closes lower, or sometimes even slightly higher, but well off the day's peak, on significantly increased volume compared to the previous day. Think of it as big institutional players discreetly selling off shares. It doesn't have to be a huge percentage drop in price, but that higher volume on a down day is a critical warning sign that the market's underlying health might be weakening. Too many of those in a short period, and you need to be cautious.
Okay, so that's a warning sign. What confirms an uptrend?
That's where follow-through days come in. These typically happen on the 4th to 7th day of an attempted rally off a market bottom. You're looking for a strong gain in one of the major averages, maybe 1.5% or more, on volume that's higher than the day before. That confirms that the rally attempt has power and likely signals the start of a new uptrend. Ignoring the market's true behavior, its direction, as many experts did in 2000, well, that can lead to severe losses. It just doesn't pay to argue with the market. Experience teaches that second-guessing the market trend can be a very expensive mistake indeed. 3. Avoiding costly mistakes, learning from history, and self-correction.
Okay, so we have the CAN-SLIM framework, we understand market direction, but the source also really emphasizes that most investors just make too many mistakes. It says it's not about your strengths, but your weaknesses, the ones you don't recognize and correct.
That's such a crucial point. And one of the biggest mistakes, according to the source, is simply not doing post-analysis, not going back and learning from your past buy and sell decisions. It compares it to doctors years ago who were ignorant about sterilizing instruments. Ignorance rarely pays off in any field, and it's definitely true in the stock market. You have to review what worked, and maybe more importantly, what didn't work from your own trading history. Chart your buys and sells. See where you went wrong.
Okay, self-correction is key. So with that CAN-SLIM strategy in hand, what are some of the most common pitfalls that can derail even someone trying to follow the rules?
Right. The first one, and maybe the most tempting for many people, is trying to catch a falling dagger. That means buying a stock because it's dropping sharply, thinking, oh, it must be cheap now. The source gives stark examples. Xerox falling from $34 to $6, Cisco dropping from $82 down to $16. These are reminders that what seems cheap can always get cheaper.
And related to that, I imagine, is the idea of averaging down in price, buying
Yeah.
more as it falls.
Precisely. If your initial purchase turns out to be wrong, the stock drops significantly. Instead of rising, buying more shares, just digs the hole deeper. You're essentially doubling down on a mistake. You should be averaging up with your winners, not down with your losers.
Another big one, which we kind of touched on earlier, is relying too much on personal opinions, right? Even from supposed experts. The source explicitly says, stop listening to Wall Street analysts' predictions.
Yeah, definitely. And this links perfectly to the analogy the source uses, the yellow dresses story. Imagine you own a clothing store. You've got a rack of yellow dresses that just aren't selling. But the red dresses, they're flying off the shelves. What does a smart business owner do? They don't stubbornly hold on to those unpopular yellow dresses hoping fashion trends change overnight. No. They mark them down, cut their losses, get rid of them, and use that money to order more of the red dresses that are selling.
Makes perfect sense in retail.
And it's exactly what you need to do with your stock portfolio. You must cut your losing positions quickly. The rule of thumb given is a maximum loss of 7 or 8% below your purchase price. No exceptions, no hoping it'll come back. This policy of strictly limiting losses, it's like buying an insurance policy. It dramatically reduces your risk down to a manageable, comfortable level.
We've focused really heavily on individual growth stocks here. What about other types of investments? Do these principles, like cutting losses, apply there too? Or are things like options or real estate totally different beasts?
Well, while diversification across asset types is generally wise, this particular strategy we're discussing is laser-focused on finding leading growth stocks, things like options and futures. They operate under very different rules, involve leverage, and carry considerable risk. They're generally not suitable for most individual investors, according to this philosophy. Real estate can be profitable, of course, but it carries its own distinct risks, especially if you buy at inflated prices or use unwise leverage, like variable rate loans you can't handle if rates rise. We saw how that played out in past market bubbles, right? Many people got overextended. The key message here seems to be Keep your investing relatively simple and basic. Focus on high-quality assets you understand, whether that's growth stocks, perhaps good mutual funds, or carefully chosen real estate. And crucially, educate yourself so you're not just blindly following someone else's advice. 4. Your path to becoming a savvy investor.
So wrapping this up, what does all this mean for you, the listener, trying to navigate the market? It really seems to boil down to discipline and continuous learning.
Absolutely. The core message is crystal clear. Success in the market isn't about luck or hot pips or having some kind of secret knowledge. It's about hard work. It's about persistence, and it's about using proven rules and methods. And it makes no difference where you're from, your background, or how much money you have to start with. The opportunity is there, in America and globally, for those willing to put in the effort to learn, train, and educate themselves.
And the source strongly encourages you, the listener, to actively study the characteristics of past successful stocks.
Yeah.
Look at those market patterns from the last 100 years. Read the book or similar materials multiple times. And, crucially, do your own regular post-analysis. Actually chart your own buy and sell points and see what happened.
Exactly. That process will help you identify what truly works for you and what doesn't. It allows you to systematically build up your weaknesses, analyze your mistakes until they actually become your strong points. It's all about self-correction and constantly refining your approach based on what the market actually tells you, not what you hope or think it will do.
Wow, that was quite an eye-opening deep dive into the world of smart investing. We've learned that truly understanding the stock market seems to be less about finding hot tips and much more about diligent study, recognizing historical patterns, and crucially, having the discipline to act on facts, not on fear or opinion.
From the power of reading charts correctly to applying the precise criteria of a strategy like CAN-SLIM, and maybe most critically, learning how to avoid those common, costly pitfalls by studying past mistakes and always cutting your losses quickly. These insights should really equip you to approach investing with, well, newfound confidence and structure.
So, as you reflect on today's deep dive, here's something to consider. If the stock market truly is, as the source suggests, human nature and crowd psychology on daily display, what specific emotions or cognitive biases might be holding you back from making truly rational, disciplined investment decisions? Thank you for joining us on the deep dive. Until next time, keep learning, keep growing, and definitely keep asking the right questions.